Hello there, I'm Ticky Fullerton, every night bringing you a full hour of the very best in business coverage across the nation and internationally, especially where business and politics meet. We've got a lot of that happening today. Union anger at Labour, throwing manufacturing jobs under the bus. We talked to AWU Secretary Daniel Walton about the election campaign commitments, state Labour in New South Wales to stop any gas development from Santos's huge Narrabri resource. Jobs from oil and gas elsewhere, though, as Bill Shorten announces his plans to boost fuel security in Australia. Energyquest Graeme Bethune gives us his take on the plans and why he believes gas import terminals are crucial for supply. And house prices now tumbling in every mainland city. EY's Joe Masters on the fallout in the property market. Plus, we'll have all the market analysis on the haul of results this week. Well, now, Phil Cronican, one of the most well-respected people in banking, both as an operator and business leader, and we can still talk about respected bankers, you know. He started in the hot seat at NAB today as acting CEO. He hopped down from the board. He took the place of Andrew Thorburn, who, along with Ken Henry last month, fell on their swords in the aftermath of the Royal Commission. In the end, for both men, it was a combination of their performance on the stand and also that neither seemed to have passed the pub test on a change in attitude. But for Andrew Thorburn, there was another issue that NAB was facing this year that would have dragged their CEO through the mud of a high-profile court case. Now, no one's saying Andrew Thorburn has been at fault here, but today that case has just taken off. This morning, businessman Helen Rosamond was arrested by Sydney police over her central role in an alleged multi-million-dollar corporate fraud scandal at the NAB. She's awaiting charges, one would imagine, over alleged kickbacks, scandal involving her business, the Human Group, which provided services to NAB, things like management events, which were actually booked through Andrew Thorburns' office and via his EA and former Chief of Staff, Rosemary Rogers.
Very senior positions are involved, obviously, or we will allege are involved. And obviously, when that individual faces court, the true extent will be known of the fraud. The involvement of CEOs and very senior executives is something that we haven't seen before.
Now, this case has a long way to play out, of course. It certainly does not put the upper echelon of the bank in a great light because of the sort of largesse involved in some of these big off-site meetings. No doubt it will also involve time and a huge amount of emotional energy from the former CEO, Andrew Thorburn, who had already asked for extended leave from the board, in part, you'd have to think now, to try and regroup ahead of this case. Mr Thorburns' painful but necessary transition at NAB continues. This week, the bank announced 180 job losses as it rationalises bank branches. Now, putting Phil Cronican into the CEO role was absolutely the right thing for the board to do. Bank Director Anne Sherry is now looking at who should take on the role permanently, but it wouldn't be much of a surprise to me if Mr Cronican decided to stay on. Anne Sherry for chair, anyone? Look for more on this story and possible charges, the Australian's margin call editor, Will Glasgow, joins me live at the desk. Will, now you flagged this a couple of days ago that assets had been frozen, and now we've got this development today.
That's right, that's right. So today we've got, another stunning day in this investigation. Well, as it went from an investigation into charges against Helen Rosamond for $6.6 million of alleged fraud. And the assets that we flagged, that's the other party on this, that is the police were pointing out there. This goes to the very senior ranks of corporate Australia, to the office, yes, not to the CEO, but to the office of the former CEO, Andrew Thorburn. And that's, of course, his Chief of Staff, former Chief of Staff, Rosemary Rogers, whose assets have been frozen as the New South Wales Police's investigation continues. No charges against her, but assets frozen. Interesting.
Yeah. So presumably Andrew Thorburn will be at some level caught up in all of this, you would think, as the case progresses.
Yeah.
I mean, as I say, no fault on his part.
But the invoices. So it's $40 million of invoices for these expenses for executive functions, and they have $40 million. Now, the period for that is 2013 to 2017. Rosemary Rogers left or resigned after she was recalled from leave, and in a dramatic meeting that we reported a margin call at the time, she left in really mysterious circumstances, perplexing the executive team. She'd been around for a decade in that role, left suddenly. What did the management say?
Management
was the reason? At the time they said that there was a lapse of judgment. That's what Thorburn said in an email he later regretted sending for the praise he put on Rosemary Rogers. That's before he and the bank were aware of exactly what was being alleged by the New South Wales Police.
Yes. So, where to from here?
Well, as we said, so Rosemary Rogers' assets are frozen. No charges against her yet. Inside NAB, they're all the gossip is about, well, what's going to happen with her? Does something follow there? At the moment, as we're on air right now in the Sydney local court, Helen Rosamond, she's in prison in Surrey Hills in Sydney, and her lawyers are down in the local court in the city trying to get her out on bail over the weekend. The police are opposing that. They want her to spend the weekend in jail in Surrey Hills ahead of her next court appearance for this.
So if this does progress through to, presumably, there will be questions asked around Rosemary Rogers. As you say, her assets have been frozen. Then it gets to the relationship that, Andrew Thorburn and Rosemary Rogers as an EA or Chief of Staff.
Who sat 5 metres apart.
They sat 5 metres, and she, as I've said before, as an EA, would have been so, she'd know everything that was going on.
She was famous for it. She was famous in the bank for being across. She'd been there because she was in the same role
under
for
Cameron Klein.
So see, these charges, interestingly, they go just back into the Cameron Klein era. 2013 means you've got about a year and a half of Cameron Klein's era. So it's uncomfortable for him too. He had her in that position as well. Now, I've said it before on the show. Thorburn, when he got into the job, people on the executive team advised him to move Rosemary Rogers on from that role. Not because of this, but it's just a sense she'd been there too long and had too much sway and influence there. But
and you can see now why Andrew Thorburn wanted the extended leave, can't you?
You sure can.
And indeed why. Probably it was a very important reason why he had to step down. I mean, imagine if he'd been here now.
This is day one of his retirement, right? He was in name at least the CEO of NAB yesterday. The charges have happened on the first day of Phil Cronican. I mean, it's extraordinary to think of if he was still the CEO, how this would rock him. And the bank again. At least it's sort of a little bit away. And the way this has run parallel, it's amazing. You had the whole of last year this investigation going on in parallel with the Royal Commission's hearings, right, where NAB was getting beaten up and had its awful performance at the Wealth Division during the superannuation hearings, and then, just that disastrous, calamitous appearance of the CEO and particularly the chair, outgoing chair now, Ken Henry. And you've had this investigation bubbling all the way through, and then, today the charges against Helen have come out exactly 1 month after Kenneth Hayne brought down his Royal Commission report. The kind of synchronicity of those two events has just been, reputationally, it's been just awful for NAB, and it's not done. It's not done yet. We've got charges, which just means it's getting even more serious, and they're going to file evidence for this $40 million of executive spending. The details of that are going to just be awful for NAB. It's going to look, in the context of the Royal Commission or post-Royal Commission world, having all this talk about executive largesse, horrific.
Big job for Phil Cronican, I think, as well. Will Glasgow, thank you so much. Right, moving to markets now, and reporting season wraps up for another 6 months. Let's get the highlights and lowlights with Junbei Liu from Tribeca, who joins me live from our CBD studio. Junbei, look, what stood out for you this season? It's been a fairly positive season, hasn't it?
I totally agree. It's really the end of it that you see investors breathe sigh of relief. The result reporting season was better than expected, especially for some of those domestically facing businesses, given as we're heading into all the doom and gloom about our economy and residential property and the like. And, most of the consumer facing companies actually did okay. And, of course, the outlook was somewhat uncertain, given we've got the politics, we've got the election coming up and, housing market clearly slowing down, but the overall result was actually not too bad. But what's really incredible and what stood out is amount of increase in dividend that took place, as well as the new buyback that took place, all thanks to this potential change in franking credit policy by Labour Party. And most of the company that were speculated that have accessed franking credit have most of them have announced that they're either off-market buyback or special dividends. So, in fact, the increase in dividend was the best in 20 years. Was quite incredible, and that really supported share price.
It's a really interesting point you make, and I suppose it shows that business is preparing for this, even if there are, many investors in the community who've got problems with it. Business is preparing for it. What about the Rio Tinto results, for example?
Yeah, that's incredible. This is what it is. While the politicians are still discussing how it will be done and how this policy will be done, and the company's already taken a step forward and going, let's pay it out. Given there's really no other, better alternative than paying back rewarding shareholders, so we thought that was incredible. Rio is another example. Announced that incredible buyback, with the capital return. We thought it was quite incredible.
Yeah. So, looking at sort of other companies this week, how did you see, say, a BlueScope and the whole issue of iron ore, I suppose, at the moment, and also the Chinese market impacting?
Yeah, look, that's really interesting. Iron ore has went on a really big rally because of short-term disruptions. Now that it's coming off a little bit, and given in terms of Chinese, some of the Chinese data that just released this week is somewhat weaker. Look, the trade conflict is still there, has yet to be resolved. Investors really shouldn't expect any improvements in a lot of those macro data. With the news flows moving towards a bit more positive, and we do expect that resolution to come through, and the market will take it to the next level. BlueScope is actually quite a good example. Good company, good result, trading very cheaply, and it really is just held back by all these conflicts. So we expect that to do quite well once that gets resolved in a couple of weeks' time, hopefully.
Now, Junbei, we spoke to both Afterpay and Flexi Group this week. I noticed that John Wiley had put money into Flexi Group, which was a little bit interesting. This space seems to be hotting up again.
Look, to me, Afterpay is going through a structural growth trend compared to Flexi Group. One is a traditional company that's defending its market share, whereas Afterpay is almost inventing its market by creating something that is, what consumers really want. They have access to most major retailers in Australia. They went into US, and immediately, within 6 months, they took on more than 900,000 active users, and those people will use more and more its product. So there is a demand for its product, and in the immediate term, that the regulatory risk really has been removed with the Senate report, as well as the the asset review late last year. So we feel that Afterpay is really in the sweet spot. It's expensive, but it is in the real sweet spot. In a few years, the company will be far larger than the rest of the industry.
Right. Now, what about milk? I'm finding it quite hard to understand the results of these different companies when you look at Murray Goulburn and Bellamy's at one level, and then you look at A2 and Jane Herdlicker's growth story. She didn't seem to be at all worried about China headwinds.
I know, it's incredible, isn't it? Look, China is a tough market. You really have to have your own niche to get through, as well as, good distribution and know where you sell it. And A2 seems to have got that right. They manage to control their inventory, control where they sell it to, and they have a direct relationship with all the retailers in offline China industry. Whereas Bellamy seems to be just a little bit on the back foot of getting to it. And recently, Bellamy just launched a new product. Apparently, it's it will capture all that omega-3 market. So hopefully that product will be interesting enough for the Chinese consumer.
Where do you sit on Woolworths versus Coles now? Coles obviously recently on its own.
I must say, both Woolworth and Coles both were very disappointing when they released their results. I'd expect better from them. The top line growth was okay, but it seems the competition between those two still very strong. Coles has launched a couple of little consumer programs, such as Little Shops and now the Stickies. It's just not doing enough to drive the shoppers into the store and stabilize the margin. So these two, with the valuation they're trading on, it's very hard to get excited about.
And Junbei, what do you think the reporting season has done overall to the market, and what are the other factors that you're looking at the moment? Are you worried about Brexit now?
Yeah, look, Brexit has been talked about for so long. It just seems like it's a tail risk that at some point might trigger something. But at this point, market is almost become a little bit immune to it at this point. Look, put that aside. The overall reporting season was reasonably positive compared to some of the global reporting season. US reporting season was pretty good as well. So we do feel that positive sentiment is going to drive market forward, especially some of those quality growth names. Seems to getting a lot of bid at the moment.
Junbei, it's terrific to get your insights. You're always so good. Thank you so much for us.
Thank you very much.
Well, switching to politics now, and Prime Minister Scott Morrison is potentially facing more resignations from his senior team amid speculation that 2 ministers are set to retire from politics. Your Money understands both Christopher Pyne and Steve Ciobo are expected to announce their retirement. It follows frontbenchers Kelly O'Dwyer, Michael Keenan and Julie Bishop, who all also announced they won't contest the next election. The Prime Minister isn't giving much away, remaining tight-lipped on the pair's impending decisions.
I talk to them all the time.
Have you asked Stephen Ciobo to delay his announcement until tomorrow?
No, I talk to them all the time.
There is speculation that he's going to be filling an overseas posting.
There's a lot of speculation going on, isn't there?
Do you think it's damaging for you just so close to election though?
No.
Do they just not want to sit in opposition?
Well, you're speculating, so you wouldn't expect me to respond to speculation.
Yeah, lots of speculation. The Defence Minister wasn't giving anything away during his Pyne and Miles programme on Sky News, but didn't deny the speculation he is set to call it quits tomorrow.
Once I decide to announce my retirement, you'll be the first to know.
Oh, come on, let's do it now. We will never get a better opportunity to win a Walkley than right now.
Do you think if I announce a retirement on Sky, Pyne and Miles will go from 12 viewers to 25 viewers over? That would be a big jump.
If it is true, yours has been a mighty career, Christopher, and I, for one, will miss you. I'll probably get into trouble for saying that, but that's how I feel.
Aren't they great? After the break, the AWU and New South Wales Labor Party butt heads on gas. My interview with AWU National Secretary Dan Walton next.
You're watching Ticky on Your Money.
Yes, welcome back. Well, now, a very interesting development we covered this week around Santos's Narrabri gas fields, development of which has been extremely controversial, of course. Well, right in the middle of the New South Wales state election, a Labor opposition leader made his way up to Coonamble and tweeted out that no way under a Labor state government would gas be developed. Watching on with incredulity was the AWU, the manufacturing union, which is hoping for new gas to underpin jobs. At the very least, the union expected Labor to run dead on the issue. Here's AWU Secretary Dan Walton. Dan Walton, thanks for coming in.
Thanks for having me.
You represent, amongst others, manufacturers in Australia. Did you know about Michael Daly's announcement around Narrabri gas when it happened?
No, we're caught a little bit on the hop, unfortunately. We've certainly been having some discussions for quite a while with the opposition in terms of forming up their gas and energy policy.
You must have been furious when you heard that coming out.
Yeah, it probably doesn't come as a surprise to anyone. We've been advocating for a long time, for a long, long time, to be able to operate onshore gas. We think nationally there's a responsibility for the big LNG operators to keep a good proportion of gas here.
Yeah.
But we also think it's the state's responsibility to do some heavy lifting to get more gas out of the ground in the state, to obviously provide a benefit to New South Wales residents.
So here is the leader of the opposition, Michael Daly, in the middle of an election campaign, going out to Coonamble, standing in front of lots of presumably lock the gate type people and locals, and saying, and then tweeting out and doing a video and saying to the world, including you guys, this should come as no surprise.
That's basically it, yep. It's quite disappointing to say the least, because what it ultimately means for us is trying to get a project off the ground which is going to hopefully provide some certainty to a lot of manufacturers who are, you know, users both in terms of gas as a raw input, but also to use it for obviously high energy facilities. They need cheap energy, they need cheap gas,
yes.
and we saw Narrabri as a prospect, as a bright prospect to be able to do that,
yeah.
so long as they went through to meet the necessary environmental and regulatory approvals.
So when we talk about manufacturing in New South Wales, I think of a company like Qenos.
Yep.
We're talking about you know, the ability to employ, presumably, in manufacturing quite a lot of people.
Yes, absolutely. So Qenos, as an example, heavily reliant upon gas. They are hopeful to get this project up. We've got a lot of members on that site. We are currently going through negotiations, and we've been working quite pragmatically with the CEO, Stephen Bell, who's trying to get a decent deal to make sure that these facilities continue operating. And you know, as I said before, both the states and feds have got a responsibility, but we've got an independent planning process on foot. And the bit that's shocking for us is, why are we going to leapfrog over the top to potentially spear a project that might get the green light through the independent planning process?
Going back to that seat, I mean, surely don't the shooters stand the chance of getting in anyway? I mean, what was the point?
Yeah, well, it's a good question, but we are, you know, as I said, we are very disappointed with the announcement. But
and there's talk as well that if Narrabri got off the ground, obviously Santos would be very keen for that to happen. That actually it could create new jobs. You know, substantially new jobs in manufacturing.
Yeah, absolutely. I mean, Santos has not only given those commitments, but Santos have already said that they would keep that gas in New South Wales. So what we've got at the moment is New South Wales produces 5% of its own gas supply. So 5% comes out of Camden from an AGL project. We import 95% of our gas from other states. Mind you, some of that gas is from CSG projects in Queensland that we currently use. The Santos project, the Narrabri project, has got the ability to deliver 50% of the state's needs going forward on a 30 to 40 year basis.
Well, instead we're going to have these import terminals.
No, I will chain myself to a fence before I ever accept the fact that we're building an import facility. This notion,
but they're going up in New South Wales because they're not going up in Queensland, because the builders of the import facilities, they can get the they can just get they don't have to pay for the piping costs. They just get the netback price, don't they?
Something should be, don't get me wrong, something should happen about the pipeline operators. There's a monopoly in place. But what we're signing up for, right, what we're meant to believe, is what they're trying to sell, is that we'll extract gas from WA, we'll pipe it to a facility, we'll freeze it to minus 160 degrees, put it on a ship it to the other side of the country, pipe it to another facility and regasify it, and then transmit it to one of the manufacturers, and somehow that's going to be cheaper than extracting gas in Narrabri and piping it to the same facility. It doesn't stack up. The economics behind it do not stack up. The only reason it is being supported is because we've got a lack of leadership taking on the tough issues about getting more gas out of the ground, and instead we're providing an opportunity for the likes of AGL and others to build an import facility to set high benchmark prices forevermore for New South Wales and for Victoria.
Let me talk about, speaking of ships going from the west to the east, iron ore and that recent layoff or end of the contract of BHP of 80 workers on board. Now, there's been a lot of pressure from the unions. I think the AWU has teamed up with the MUA to put pressure on Aussie Super, actually, to then put pressure on BHP. Now, at what point does this start being a difficult governance issue?
Well, there's obviously necessary declarations that people need to make throughout that process. But what this is fundamentally about is standing up for Australian seafaring jobs. There's 2 ships that have been operating for a long period of time. BHP have decided that no longer are they going to have Australian flagged vessels. And we have rightly stood by the MUA in support of those workers. We think that...
No, but there's a difference between standing up and down and being vocal about it and then actually using the influence that unions have with, say, an industry super fund to then go and pressure a company which has got to actually make their own decisions about who they employ and whether they can afford to employ or whether they invest for growth, which actually presumably will create jobs.
Yeah, well, I think if you have a look, obviously we've just gone through the reporting period over the last couple of weeks, and if you have a look through, a lot of companies now are focusing more on their ESG responsibilities, and industry super are significant investors in a lot of Australian businesses and global businesses, and they are very keen to make sure that the ESG responsibilities are being met.
But one thing is climate. You know, we've got the Climate Action 100 Plus group. If this starts becoming an issue where, say, the ACTU is pushing industry super to demand that companies increase wages here than everywhere because there's an issue of low wages growth, for example. Now, Innes Willocks is on the board of Aussie Super, I think, as are you. He just told me this week that, you know, he's going to put a line through that idea for the ACTU. That was not happening, that sort of influence.
Yep. So Innes, obviously being the CEO of Australian Industry Group, is... You know, he's got differing roles as well, and is responsible for putting those positions across. One thing's for certain...
But you think it's okay? You think it's okay to have that sort of influence on corporate Australia? Because obviously the money behind an organisation like Australian Super is massive.
Yeah, absolutely. You know, and rightly so. As a growing fund, Industry Super is a fantastic initiative, and it's going to grow from strength to strength. I think that the ACTU certainly has a role to be advocating for wages growth, and as part of that, be it advocating through industry super or directly to businesses to say that Australia needs a pay rise. They've been pressing that case for a long period of time now. I don't think it's going to come as any shock. I think, you know, given the situation we find ourselves in Australia, I think it's a good thing.
But it turns the tables a bit. I mean, here you are also down at BlueScope. I spoke with Mark Vasella the other day about the idea of this profit share, maybe, with employees. How's that going? Is it any closer to resolution?
No, as I've said to Mark many, many times before, I mean, BlueScope certainly developed deep pockets with short arms at the time that the good times returned.
But he seemed to say to me that this share was something that you were moving forward with.
It's not necessarily the basis of the outcome. We've got meetings taking place on Tuesday down in Port Kembla. We've got all of our members coming together for a mass meeting to give basically some direction. There is an offer on the table now, which has certainly progressed from the last time that we spoke, which is around a 3-year agreement, which shifts pay, you know, from the 9% that we're bogged down in to around 11%. Early indications are quite supportive from our members, and so hopefully on Tuesday we'll get that endorsed. And it's been around a year of negotiating, unnecessarily long, and there's been a huge amount of industrial action unnecessarily taken to get us to this point. It could have been solved a lot quicker, but hopefully we'll get it done.
Indeed. Finally, can I ask you about Bill Shorten's announcement around energy security? Now, he wants to actually have a lot more storage here, a lot more ships going around, presumably, with fuel in them as well. That's good for workers, good for your workers.
Yep.
But do you see this as of itself sensible policy?
Yeah, absolutely. Nothing but ticks. So we look after a lot of the oil refineries in the country. Obviously, we're down to a limited number of refineries still operating, and refining capacity has dropped. I think we should be doing everything we possibly can, given the sort of uncertainty around the world, to make sure that we do maintain a refining capacity. So we've got to protect the existing operations, and we've got to have a look at being able to build additional capacity. Storage is just a cheap and easy way. We look after the workers that maintain the storage facilities.
You'd put refineries back in Australia?
Well, we've still got a couple operating across the board, right? We've got 2 in Victoria, 1 in Queensland, 1 in WA. And we look after 3 out of the 4 of those. Our preference would be, and we work with those companies quite often, to make sure that we've got the right mix in terms of the changing regulatory environment.
You don't buy the Julian Siegel at Caltech's argument that actually there isn't an emergency issue here, because refineries are from many parts of Asia. They're not all going to turn on us at once in terms of security.
Well, if we end up as a nation that imports 100% of our fuel, 100% of our refined fuel, then we leave ourselves massively exposed. And I think credit to Bill Shorten, he's identified that risk. and he's making some moves. I know it's starting off a conversation to try and get all the players in the room. But if we walk away from these last 4 refineries operating, we've got no refining capacity.
But there's no risk of that at the moment, is it? I mean, that's not going to happen.
Well, we continually go through cost-cutting measures with a lot of the refineries around the place. They're still trying to remain competitive. There's talk about fuel standards changing, and that's going to have a cost implication on businesses in terms of having to update technology in the facilities. And so we want to work through that in a sensible way to make sure they continue operating. We think they've got a very important place in Australia's economy.
Dan Walton, great to talk to you again. Thanks so much.
Thanks, Ticky.
After the break, we'll keep talking fuel security with Energyquest CEO Graeme Bethune next.
This is Ticky on Your Money, covering the big business stories.
Welcome back. Opposition leader Bill Shorten has pledged to boost Australia's fuel stocks if he wins the next election. Mr Shorten will immediately move to boost the nation's emergency fuel levels if elected. Amid criticism, the coalition has failed to meet the International Energy Agency's requirement for nations to have 90 days of supply. He wants to establish a fuel security corporation, tank farms and research into alternative fuel to become less dependent on international reserves. So do we really need this? And what benefit or impact will there be for the Australian energy sector? For more, I spoke with Energyquest CEO Graeme Bethune earlier. Graeme Bethune, thanks for joining us there in Adelaide. Graeme, I'm wondering first what you make of the Labor leader Bill Shorten's new policy around security for energy.
Well, in relation to the fuel supply security, I think in principle it's good to see a government planning to take that seriously. We haven't really seen a lot of serious interest in by any federal government over the last few years.
Yeah, so you think it's a good thing. What's it going to cost, do we think? I mean, there's numbers flying around 10 to 20 billion.
Yeah, well, it depends very much how it's done, and we haven't made our own cost estimate at all, and it would. So the one important thing is to make sure you do it as cheaply as possible. Some of the proposed ways are obviously by having Australian crude shipping and things like that. I can't really get into those issues, but I would make the point that New Zealand now satisfies the IEA's 90-day requirement. They used to. They've been able to do that now. I think largely by effectively storing oil and other products offshore.
Yes.
And having kind of call type arrangements. So they've been able to do that successfully. The sky hasn't fallen in New Zealand, I don't think.
And do you think the part of this, you mentioned having Australian workers on board, is that part of the storage, having Australian ships at sea with some of this storage as an inventory?
Well, as I say, I'm sure there are many different ways of doing it. You might do that. It doesn't particularly matter whether they're Australian ships, and in fact whether they're in Australian waters or in other waters for that matter, either or for that matter in international waters. But it's interesting that Japan and Korea both have 200 days. New Zealand has 90 days now, and Australia only has 50. So either the Japanese and Koreans are really dumb and we're really smart, or possibly vice versa.
But you do worry about it in terms of being a national threat. You don't buy, say, Julian Siegel's argument at Caltex, which is, you know, if you as a nation are relying on the supply of fuel from a number of different refineries from a number of different countries, that spreads your risk.
Oh, well, that's certainly right, but it's we're not actually relying on a large number. We're relying on a relatively small number of refineries in Singapore and largely Korea and Japan. But you've also got to recognise here that I mean, this is an international agreement with the International Energy Agency. All of their members are supposed to play their part, but effectively Australia's just free riding on, particularly on Japan and Korea. So if you get a natural disaster in Japan that wipes out some of their refineries, which affects Australia, then if Australia hasn't been doing its bit and can't do its bit, how much can we rely on our partners?
OK. Well, let's come to the resources here in Australia. I note that Michael Daly, who's Labor opposition, sitting here in the middle of the state election campaign in New South Wales, has made it very clear that Labor's policy is now not to support any change to Narrabri. What is your current take on that?
Well, I think it's unbelievable. I mean, we've had endless inquiries into the environmental effects and regulation of onshore gas production. They've all, I think without exception, come up and said that it can be well regulated and safe and in relation to the water supply and all those things. I'm sure the New South Wales government's quite capable of regulating it appropriately. So it's very hard to see why it can't go ahead in a situation where New South Wales gets all of its gas from other states.
More broadly, where are you seeing the pressures now? Because you're a big supporter, of course, of the building of import terminals, aren't you?
Yes, that's right, and for a couple of reasons. Well, there's a couple of things happening. Firstly, on our detailed assessment of the performance of the coal seam gas fields in Queensland, and I mean they've been a terrific thing, and they're producing a lot. But the whole problem is that the whole thing was overdone. It was a bridge too far in some ways, and on our numbers, those fields will start to decline probably around 2025. And at the same time, you've got the decline in offshore Victoria, which we can see already. So you've got this double whammy, and you'll need a number of things to alleviate that. One is increased diversions from Queensland, which I think is possible. Also, if you could get Narrabri up or anything like that, that would be fantastic. But also, you'd need the import terminals as well. From about 2025. We can see Queensland production falling by about 100 petajoules a year, which is about the size of an LNG import, one LNG import terminal. The import terminals have a regasification facility then to put the gas into the network.
Right.
One of the other things about the import terminals is, of course, this would provide more competition in the wholesale gas market. So you'd have two new parties there supplying gas, so that broadens the competitive range, which is probably a good thing for the market as well.
Yeah. I've been reading about blue energy up north there. Fines seem to be, they've got reason for optimism up there. Does that change your view at all about the quality of the resource in the north, in the Bowen Basin?
Well, the North Bowen Basin historically has been very hard going. There's only one producing project at the moment at Moranbah, which has Arrow Energy and AGL in it. AGL have just tried to sell their interest, and that's fallen through. So the quality of the gas is on the reserves or resources isn't as good as it is in the further south in the Surat Basin, and at the same time there isn't a pipeline. But I'm sure if the infrastructure was in place, that would certainly improve the commerciality.
So what does this all mean for gas prices going forward, Graeme, do you think?
Well, to try to take the heat off gas prices. I mean, it's very, very hard now that the market is effectively, the domestic market is effectively linked to the international market. So to some extent,
well, Rod Sims did that, didn't he?
Yeah, I think that's right. So sort of convinced buyers and sellers that it should be the international price, although that was happening anyway. But so you're a hostage to what's happening there. But exploration, obviously, exploration takes time. That's the problem with it. I would also say developing as much of the existing gas that we know about as possible, and as much competition as possible. So more than rather than banning LNG import terminals, 2, 3, 4, 5, I mean as many as possible would be good. But also being able to access gas in New South Wales as well. One of the interesting things at the moment is that even though we've got record high gas prices, there are all these other constraints on development.
There are indeed. Graeme Bethune, always great to talk. Thank you very much.
Thank you.
Now, the fallout from the abrupt end of the Hanoi summit continues, with North Korea disputing US President Donald Trump's explanation for his decision to walk out on the talks. But questions are being raised about how the summit went ahead without basic understandings being ironed out first. Sky News reporter Amanda Walker is in Hanoi.
Donald Trump, of course, is keen to pitch this as certainly not a victory, but certainly not a failure either. But obviously, you have summits like this. There's a lot of groundwork that goes in beforehand from each country's teams. And there is a sense that certain things should be ironed out before the leaders come for this very high-profile situation. So this idea that sanctions, which Secretary of State Mike Pompeo said a few days ago, would not be lifted without complete, verified denuclearization. The fact that all of this pomp and circumstance and ceremony was allowed to happen without that very crucial understanding being ironed out first is something that you can criticize. We all got that White House schedule which said that there would be a signing. That didn't happen, so it's hard to see this as anything other than a failure when Donald Trump, the US president, so desperately needed a win.
After the break, back home, we'll discuss this housing slump with EY's Joe Masters next. Welcome back again. Now let's talk house prices. Dear oh dear, they're tumbling in every mainland capital city at the moment, with the nation's real estate downturn now the worst on record. Australian home prices fell a further 0.7% last month and are now down nearly 7% from their peak. Figures from CoreLogic reveal house values in Sydney dropped by 1.1% last month, down 11.5% over the past 12 months. The harbour city is now home to 7 of Australia's 10 worst performing metropolitan markets. In just 19 months, median house prices in Sydney have fallen by more than $160,000. Meanwhile, Melbourne values tumbled by 1.2% in February, making it the softest capital city market in the country. CoreLogic's Tim Lawless says the recent crackdown on lending conditions has exacerbated the housing downturn.
The major factor driving this downturn is credit availability or the lack of it. You can overlay all the different credit policy decisions we've seen around the macroprudential and then more recently the tightening of serviceability in line with the Royal Commission, and it lines up perfectly with transactional activity in the marketplace. It's much harder to get a loan.
Well, let's unpack this market. I'm very pleased to welcome Joe Masters, Chief Economist at Ernst & Young Oceania, who joins me live at the desk. Joe, is this grim news going to continue?
Well, I think it is going to continue for a time. We've had a couple of pieces of news in the last few weeks, though, that suggest we might be nearing the peak of the deceleration. That doesn't mean that prices rise, but we had seen through the latter part of last year those price falls each month get larger and larger and larger. But actually in February, the price falls in both Sydney and Melbourne were still big, but not accelerating.
And the drop in residential construction that's come through this week, how does that play into it?
Yeah, so I think that's quite important. We had thought there was quite a strong pipeline of residential construction work that would keep the level of residential construction activity quite elevated. That looks like one of two things is happening. Either we've worked through that pipeline faster than we thought, or there's a little bit of congestion around getting supplies in and that type of thing that's sort of slowing that process down. But clearly residential construction will not be a tailwind for the economy going forward.
OK, but going back to these house prices, do you think this is right, that really the big issue now is credit?
Look, I think there's lots of factors. I think this slowdown in the housing cycle started with the tightening up of credit. We saw that through the macroprudential controls from APRA, which really targeted investors, actually, mostly, and that's where we saw the weakness.
We're through that now.
We're through that now, and then I think we've seen the bulk of the credit tightening. I don't think we're going to see substantially more tightening in the availability of credit. And actually, there's a few indicators that suggest most owner-occupiers can still get the amount of credit that they need or want to draw down. So we saw that in some of the banks' annual reports in the last few months or so. So I think it's now a combination that it's just taking longer, it's a bit harder, you can't get quite as much, but there's also clearly an expectation of further price falls and a sentiment overlay on top of that.
And
so it's demand and supply.
Rates seem to be moving.
Yeah, clearance rates, they seem to have improved a little bit. There's a bit of seasonality in that, but I'm quite encouraged that they haven't continued to get worse.
Yeah. All right, well, look, watching all of this, of course, is Philip Lowe at the RBA. He's got another rates day coming up next Tuesday. How's this all playing in, do you think?
Look, I think there's a lot for the RBA to absorb here. We know from the last meeting that they're clearly looking at the housing market, not so much the prices of house prices per se, but the interaction with the consumer, which is the biggest part of our economy. In terms of the residential investment construction side, a slowdown there was expected. So I think it's really that consumer angle they'll be watching very closely. From my perspective, I think it's a combination of, do we continue to see strong jobs growth, which helps to offset that wealth effect from lower house prices?
Yes.
I think lower house prices are a much bigger problem if we start to see some slowdown in employment and a tick up in the unemployment rate.
Yeah, because we haven't really seen it in, say, some of the bank results. We haven't seen, you know, any sort of big concern in terms of risks on repayments of loans or that sort of thing not coming through at the moment.
That's exactly right. If you look at mortgage delinquencies and non-performing loans, they're up a bit in Western Australia, which has been actually a multi-year process and probably has a bit further to run.
But unemployment's higher over there.
Absolutely. Yeah. And they've had the unwinding of the mining boom. So quite a unique sort of economic situation over there. But you're absolutely right. Like broadly, we're not seeing those delinquencies rise. And actually, the average buffer on a mortgage is actually quite solid.
OK. So wages growth, obviously, another big factor and something that Philip Lowe has been talking about now as he's really a central issue for him when he determines rates. Now, he's got a different view on things than he had in January. Are you expecting him to actually lower rates before the end of the year?
Look, I don't think so. I mean, obviously, there's been a bit of a moving around from some major economists on that. From the way I think about that is totally related, really, to the unemployment rate. I think if we continue to have an economy that is strong enough to keep the unemployment rate at 5%, or perhaps even, as the RBA expects in their forecasts, gradually trending lower, then it's steady rates. I think if you start to see an unemployment rate that is trending towards 5.5%, then you might see some sort of policy response.
Yes. All right. Well, so in terms of locking in, anybody taking out a mortgage right now, do they wait and lock in their fixed? Do they lock in their fixed now, or do they wait possibly and?
So we have seen fixed rates come down on the back of what we're seeing in bond yields. So,
but they might come down a bit more.
They might. Well, and also it's that comparison between the variable rate, which is priced off the cash rate, and fixed rates. So, you know, I think it's a very difficult time. What we do know is overall interest rates haven't really moved substantially higher over the last year. So the average interest rate being paid is about the same as it was a year ago, a touch higher.
What do we think of these capital expenditure numbers? Because they were pretty good, weren't they?
Well, they were very good in terms of the outlook. The actual Q4 number and the bit that feeds through into the national accounts looks quite weak. So I think GDP next week could look quite soft. But it is encouraging that the first estimate of what firms plan to spend in 1920 look quite solid. The first estimate can be revised quite a bit. It's a little bit rubbery. But I think it is encouraging that despite the fact business confidence has come off in the last few months, firms' plans about what they actually plan to do look okay.
Yeah, and I was talking earlier with Jim Bailu, and we were talking about it's been really quite a reasonable corporate reporting season.
Absolutely. So corporate profitability is quite high. We know that corporates are not overly leveraged like the household sector is. So CapEx plans are important. It is important for the RBA, though, because their forecasts for economic growth do imply a pickup in business investment, non-mining business investment in particular. So it will be important for that to come to fruition from that survey.
And big week next week.
Big week next week. As always, we'll get the Q4 GDP, which is really important, gives us the most comprehensive read of the economy, but quite dated. It's Q4. And we'll also get some of the partials around retail trade, building approvals, the trade balance. So a lot to absorb, and of course an RBA meeting with a post-meeting statement.
And all with the context of we've still got this trade issue, US and China, and presumably concerns about China overall.
Absolutely. I mean, China is still the #1 risk to the Australian economy. It has actually been for some time now, but the trade tensions obviously overlaying what already looks like quite a challenged outlook in terms of slower growth, the need to deleverage, the need to deregulate.
Jo Masters, great to talk. Thank you very much.
Thanks.
And that is all for the show tonight. See you on Monday at 4:30, only on Your Money. Thanks for your company.